I tell everyone, you date your mortgage. You don't marry it.
Right.
Okay? How many people keep a mortgage for 30 years?
This is Laricy Live, and I'm your host, Matt Laricy, giving you unfiltered access to the world of real estate. We cover market trends, news, and give you the honest answers that will keep you ahead of the real estate game. So today we are here talking about a big issue that's been happening right now, and that's rates. I don't know if you guys heard. Rates are a little bit different than they were at the start of the year. So we have the number one lender in the country, Ben Cohen, with Guaranteed right here to help discuss what's been happening in the marketplace and a special topic of rate buydowns. Ben, how we doing today?
We're doing great, Matt. How about yourself?
I'm still breathing. I can't complain.
Good. Happy Wednesday.
I feel like I'm having a good day today. I don't know what it is.
You're always having a good day.
I feel like today's going to be a good day. Now, Ben, we got a lot of people are depressed. There's a lot of doom and gloom news out there.
Sure.
Rates are high. We shouldn't quote rates right now because by the time this comes out, it'll probably be different, better or worse.
Correct.
But rates are they all-time lows right now? They're doing really, really well?
Yeah, they're like 2.5%.
Yeah, 2.5%. Yeah. Rates are getting demolished. And we're high, right?
Yes.
Is this the highest you've seen?
Yes, this is a 14-year high, and I've been doing this for 18 years. So I guess when I first started, rates were in the mid-8s selling mortgages, and you had to pay points and had to put 25% down and all that crazy stuff. So,
and then we've had this whole fictitious low rates since COVID started.
Yeah.
Specifically in 2021 and 2022, they got really, really low. And I remember people were saying that they were going to go to zero.
Yes.
And I was laughing because I'm
negative, actually.
Yeah. I know Mickey in our office we had a bet out there.
Yeah.
That he said they would go to zero before they would go to 6%, which he's lost that, by the way. He owes me some money on that. But anywho, a lot of people thought that. And I kept saying, like, American average interest rate 6.5%. So they're going to go up. At some point, we're living on borrowed time. And now that borrowed time is up, unfortunately, it's happened really quickly. And we're seeing these record high interest rates. Do you think that these rates are here? They're going to stabilize? What do you think is going to happen with that?
I think it's going to get better. I think it's going to get worse before it gets better. I mean, that's been the trend since January. You know, I have these days, these events in my career where you kind of remember when things started to shift. And I remember January 3rd specifically was one of those days where you just started to see things start to sell off a little bit more and more. So, you know, based on everything I read, based on everything, you know, I think everything is going to remain expensive until they get inflation under control. I don't care if it's your mortgage rate, your auto loan, your credit cards, your milk at the grocery store. I mean, that's what I have to try and remind people that what isn't expensive at the end of the day. You know?
Inflation's high.
And this is a payment. This is a payment environment, not a rate environment. As I tell every customer, nobody likes the rate that they get today.
Yeah, and rates are unfortunately affecting the market. It's making the markets, I wouldn't say crash, but it's, in fact, I read an article earlier today that buyer demand's almost at 2008 level. So it's dropping big time. Now, you know, I tell people in my markets, in all honesty, demand sucked in 60% of my markets as it's been since the pandemic. I've been selling high rises in the heart of the city. So, you know, when people aren't living in the city and they're afraid to be around other people, like, talk about it being dead. So, like, to me, it's like some of the stuff is like, it's not really much different than it's been. Kind of sucks that we didn't get the advantage of a better market. But, you know, the rates are the rates. Now, what's going to happen, nobody knows. Nobody has a crystal ball. But, you know, as we talk about rates stabilizing and trying to spur demand, there's a big thing that people are doing, and that's trying to buy down rates. Ben, what is a rate buy down? What does it even mean?
Well, there's different things. This is a newer product that we rolled out maybe 2 weeks ago. So typically when somebody buys down an interest rate, they'll pay a point, okay? And let's just say you have a $400,000 loan. You're gonna get a 6% interest rate as an example. Yeah. You're gonna spend an extra $4,000. You're gonna reduce your rate by a quarter point. Okay,
so what is a point though? Just
a point is 1% of the loan amount.
Okay, so you guys got that 1.1%.
Yep. $400,000 loan, $4,000 fee. You take your rate from 6% to 5.75. Okay. It's going to take you 5.5, 6 years to break even on that. That's why I've never been a fan of paying points when you get a house.
So you're saying you could spend 1%. And you get
of the loan amount
to get a 0.25 reduction on the rate. Correct.
Correct.
How far down can you buy down a rate?
Well, you run into things like high cost loan limits where we can't excessive, even though you come to me and say, Ben, I want to spend $50,000 and buy my rate down.
Yeah.
You can't. So there's systems put in place to make sure that a consumer isn't getting ripped off. And nobody would ever do that at the end of the day, because again, what happens is that break-even point still stays the same, right? So now you're just now you're going to spend $8,000 to save 0.5% on a rate.
Right.
Your break-even still 5.5 years.
Right.
And I think everybody knows at the end of the day, and especially me, if I was a betting man, we typically see a refinance boom every 18 to 24 months. So why are you going to spend all that additional money if you can't recoup it, if you think there's a chance that you're going to refi your mortgage?
Right.
And you got to assume when they get inflation under control that rates are going to start to come down. Now, there's no guarantee.
It's a big assumption.
There's no such thing as typical and normal. I try to stay away from those words these days.
Right.
So
you look at I look at history, and I believe history repeats itself.
yeah, 100%.
We're kind of like in like the early 80s years of what kind of happened. Everything, honestly, it's like almost identical of where the economy is and what's happening with inflation and the stock market and rates and everything like that. So, this could last 5 years. This could last 5 months, but what a lot of people are trying to do is they're trying to spur some demand on their listings, or buyers are trying to spur some, motivation of what to get me going. So the rate buy down program has been pretty big. Do you see sellers really involved in trying to get rates to be bought down?
Well, so now let's touch on a different topic, okay? So you kind of talked about the buy down program. My initial comment about paying 1%, which is the $4,000 and reduce your rate a quarter. Nobody's doing that right now, okay? The only reason you're paying points is if you're going to a lender that has to charge you points.
Okay.
Or you're buying a second home, you're buying an investment property. Right now, those typically require you to pay a point, and you've never had to do that, okay?
Why is nobody doing a buy down right now?
Because of the break even.
Oh, okay.
They think rates are peaking. Why would I spend money to spend an extra, if it's going to take me 5.5 years to break even, I think I'm going to refinance in 24 months. I'm not going to ever recoup my costs.
Right.
So that's where this buy down program, which is different than buying points.
Yeah.
Okay. So let's talk about what it's called. There's a 2-1 buy down program.
Okay.
And there's a 1-1 buy down program. So if you stick with the easy example of, I'm going to buy a house for $500,000.
Right.
I'm going to put 20% down. I'm going to finance $400,000.
Okay.
Let's just say you get a rate of 7% today.
Mm-hmm.
Okay. What happens is you can get this has to be a seller concession.
Yep.
Okay. So the seller has to pay for this for the buyer. At the end of the day, like we know, it's no different than any other normal seller concession you would do in any other transaction.
Yeah, like a closing cost credit.
It's going to be built into the price that the seller's
Yeah.
willing to pay for the home. But if you've got a listing for $500,000, so you can do 2.2% base. It could be 2.1, 2.2, 2.3, depending on what the final rate is. So let's just use the easy math and say it's 2.2% as an example. Okay. What ends up happening is that's basically $9,300.
Okay.
Okay. So somebody's going to spend. I'm going to come to you as a buyer, and you're the listing agent. I'm going to say, Matt, I want to buy this home for $500,000, and I want a $9,300 credit from you. Okay, you're going to factor that into whatever price you're willing to sell me the home, like you would any other seller concession.
Yeah.
Okay.
It's essentially like a $493 offer.
Yeah.
That's the best way to look at it.
So think of this as almost like a teaser product. So now your rate is 7% today. In year one, your rate is 5%. Okay, so 2-1 buy down. So you buy down the rate, you spend the $9,300 from the seller, which essentially just gets wrapped into the purchase price.
Yeah.
Okay, now in year one, your rate is 5% instead of 7%. Year two, your rate is 6% instead of 7%.
Yeah.
And then in year three, it goes back to 7% for the life of the loan. Okay. Now here's the beautiful thing about it. You are essentially saving $6,000 a year in your first payment.
Yeah.
So you've used now $6,000 of the $9,300 that the seller's given you.
Yeah.
Let's just say hypothetically in 12 months, I call you and say, hey, Matt, guess what? Rates have gone from 7% to 6%.
Right.
You can refinance this mortgage. Any money that you have not used, call it the $3,300, gets given back to you when we refinance the mortgage.
Right.
They add it to the principal balance, which reduces how much we're paying off.
Right.
And you can either take that $3,000 and you can use it to spend money on a refinance, or you can put it in your pocket.
So it's a 2-1 buy down.
It's a 2-1 buy down. Yeah.
And it costs on average 2.5% of the purchase price.
2.2% of the loan amount.
Of the loan amount.
Yeah.
Okay. Okay, and is that strictly to regular loans, or is it jumbo loans?
Great question. Fixed rate mortgages only, conventional FHA and VA only.
Okay.
There is no product for jumbo on this yet.
Okay. And it's a big, so like here's a good idea for people out there that's nervous about rates, because could be wrong. Personally, I believe that rates will go down next year. I don't think they'll go down to 3%, but I don't think they'll be in the 7s. I have a theory that I think they'll dip below 6, not a lot below 6, but I think that's where they'll be. So, even if you got one of these done, you take advantage of prices, because prices are down right now. When you get a buy down and then you refinance, you're still ahead of the game.
Yeah. I think this is a win-win for a buyer and a seller. So let's play this back. Let's just say you've got this listing for $500,000 and you've got no traffic coming into it. Okay. And you go, what are you naturally going to tell a seller when you don't have traffic?
Drop the price.
Drop the price. Okay.
Well, personally, just so you know, like I don't use the drop the price as a normal answer, because I always tell people, if nobody else is selling, that's not a market issue, or it's not a price issue, it's a market issue. And like if we put it at $1, of course it'll sell. But if none of my competition's selling, I don't see a point just like free falling in price drops.
Okay, you're unusual.
That's my personal theory. But I do agree that the average agent, if he doesn't move, you just say, let's drop it 5 and see what happens.
Correct.
They're throwing dirt at the wall to see if anything sticks.
So now, in theory, let's just say, you know what, we've got to drop the price 5%. So we're going to go from 500 to 475 because we want to make it more affordable for a buyer.
Right.
Okay. Well, guess what? Now you go to your seller and say, how about you drop the price, or we give a $10,000 credit to the buyer instead of dropping our price.
Right.
And now the buyer wins because they save basically $9,500 over the first 2 years.
Yeah.
And now you don't have to reduce your price as much to get a buyer in there.
Yeah. So this is just kind of like what we say would be a creative way that would be a win-win strategy, where the sellers can take advantage of a new product to try to help move their property, and the buyer is going to take advantage of, not be so scared about the rates.
Correct.
Because rates are extremely scary, again, because my personal belief is the sole fact that, most people that are buying, all their friends have recently bought and they got it at 3%. And within, a 1 calendar cycle, it's, more than doubled.
Yeah.
And that's scary moves. Now, when we talk about these buy down programs and things of that nature, what about real answers about what rates really are? You talk to 4 people, they range from 4% to 9%.
Yeah.
Why is there such a wide swing in where rates actually are?
Because every borrower is completely different, right? What did they spend? What's their credit score? What's their income? What's their assets? What's their price point? What's their close date? What's the property type?
Yeah.
When did they lock a rate? When did they not?
Higher rates than single family homes.
Correct. Yeah. Condos, unless you're putting 25% down, typically condos are a little bit higher of an interest rate.
Because they go online and they search and they see
Correct.
Yeah.
Correct. So, at the end of the day, that's kind of how it works. So, everybody will say, well, what are your rates today? Well, first of all, what hour in the minute of the day are you calling me?
Correct.
Okay. Take today as an example.
Right.
Today is a bloodbath on the bond market. We saw 10-year treasuries open at 4%. Now we're trading at 4.1%. That's a big swing.
That's a good thing.
That's, an eighth to a quarter point in rate.
It changes a big...
What I told you yesterday when I gave you the pre-approval and said your rate was 6.875, now you call me today and say, Ben, guess what? Great, I'm under contract. Okay, now your rate's 7 1/8.
Are you recommending people to not lock in if they're high out of a day and be like, let's wait and see what happens tomorrow? Or
no, because I can't predict what a rate's going to do from one day to the next. And everybody always asks me that. And if I could predict mortgage rates, I can promise you one thing: I wouldn't sell mortgages for a living. So
I'm gonna be getting shit on all
you
day.
always get your interest rate locked in. Why? Because you know your worst case scenario,
and it can't change.
Now it can't change for the worse. Okay.
Yeah.
However, if all of a sudden rates go from 6 and 7% to 6.5%, you can float your rate down. Okay.
Yeah.
So typically the rule of thumb with float downs, if rates get better by a quarter, they meet you in the middle and give you 1/8 of a point. If rates get better by a half, they give you a quarter. They don't just let you float down to current market, because that defeats the purpose of getting a rate lock. You can't buy a stock today for $10 a share. It goes for $5 and say, you know what, I want to return that and I want to get new price. No,
awesome
you double down and you hedge.
And,
yeah, of course. Well, that's just not the way the world works.
So when we look at rates, you have 30-year fixed, and then ARMs are getting really aggressive right now.
Yes and no. It depends. You know, you've got mortgage rates basically trade off a 10-year treasury market. Okay.
Yep.
You've got a 2-year treasury market out there. So at the end of the day, everybody's asking about harms because typically that was the situation. Okay.
Yep.
If a fixed rate mortgage was 5%, you'd get an ARM at, 4% as an example.
Right.
Well, right now, you've got a 2-year and a 10-year treasury market, and the 2-year is trading higher than the 10-year, which creates what's called an inverted yield curve. Okay.
Yep.
When you have an inverted yield curve, you start to see shorter term mortgages basically pull back. So sometimes, again, depending on the client, right? Sometimes that ARM rate could be 0.5% better. Sometimes that ARM rate could be worse.
Do you recommend people to get ARMs?
Only if it makes sense and there's a savings. If you're saving an eighth of a point to do an ARM over a fixed rate, no. Why would you do that?
Yeah.
If you're saving 0.5%, you're going to refinance that mortgage or you're going to be out of that house. Why wouldn't you save the money?
Right. I always recommend ARMs if it's a condo, because most of my clients are in 3 to 6 year places.
Yeah.
And typically, up until recently, the ARMs were aggressively lower than the regular rate. So
they always are historically.
Why spend an extra percent if you're definitely not going to be there for 30 years? 30-year fix is just, I feel like the MO, people are like, I don't know, here's a 30-year fixed rate, et cetera. I'm always like, just get a 15-year or 10-year
Well,
ARM.
that's what our parents did.
Right.
Because
they'd also, like, and I tell those people, like, your parents probably still live in the same house. I'm like, well, yeah.
They do. And they spent $100,000
and I'm like, you're telling me
house.
right now you're going to be here for 4 years. Like, why pay the extra juice?
Listen, I think I've always felt this. I think everybody thinks that when the financial crisis happened back in 2008 and 09, that everybody who got themselves into trouble was because they had an ARM.
Right.
It's not the reason.
Right.
Okay. Guess what? ARMs actually got cheaper when the financial crisis happened. The people that got into trouble are the people that put no money down.
Right.
The people that did 100% interest only, and their property values went down. And oh, by the way, they bought a house they couldn't have afforded to begin with. Those days are over. You can't buy a house and get a mortgage if you're not qualified to buy a house.
But the other thing is people, and you talk about the financial crisis and stuff like that, and people think like, the market's going to crash. And I think in some areas, prices are going to come down heavily. But then again, like, you still need inventory. And the fact is that like all these people who locked in at 2.5% to get a place that planned on living there for a while, like, and if they're not financially hurting, like, why are they going to want to fire sell it when they got a rate of 2.5%?
They won't.
So that's the thing and that's why I think that there's going to be a big difference between like a crash and maybe more of what I would call like maybe a correction.
A reset, yeah.
And a correction doesn't mean prices are going to plummet. A correction just means that like things aren't going to be as hot. Like I always tell people, like even when people tell me, oh, the market's the greatest ever, and I got buddies in California and Florida selling, they're saying things go up $1 million. I'm like, listen, like if real estate was meant to sell in a day, like we wouldn't have careers. I'm sorry, but it's true. Just you wouldn't have it. Like what's the point? You put it on the market, easy transaction, it's done. You don't have to do anything. The reason they hire realtors is because it's a pain in the ass and selling sucks.
Yeah.
And now you're just going back to the time where like you have to do inspections again.
Yeah.
That I was on, this is a good story talking about rates and stuff like that. When we talk about how hot the market's been, I was on a panel talking about real estate, and the big topic is why we should get rid of feedback. And they said that agents should never ask for feedback on listings. And I said, well, why? And they said, well, because everything sells in a day and you're just annoying people, blah, blah. And I said, well, guys, in my markets at this point, we had 12 and a half months of inventory. I'm like, I haven't had a showing in months. So you're telling me after 2 months of no showings, I get my first showing and the seller asks me how it goes. And I say, hey, guys, sorry. It's not right to ask for feedback. You tell me with 46,000 agents in Chicago if I'm going to keep my job, right?
Right.
Now, as the market's starting to shift, these people are starting to get their head out of the sand and be like, holy shit, like it's tough to sell a place. Not everything's selling in 5 days. And rates are slowing down. I actually think rates rising is a very strong thing and a good thing for the market, because the market got unhealthy in a lot of parts of the country, which we needed this.
I mean, that's why they're doing what they're doing. I have to explain that to people on a daily basis. Listen, I don't have my degree in economics, right? But at the end of the day, you have to bring supply back in with demand.
Right. That's it.
Whether that's buying a car or buying a house. Think about it. Go try to buy a car right now. Yeah, it's a 1.5 year wait to get a car.
Right.
Like, so, and the dealers are taking advantage of buyers when you buy a car. Now it comes in a year later. You decide not to buy it.
Right.
Now they've got that car on the lot that nobody else can get.
Yeah.
So guess what? I'm going to add a market adjustment to the price of the car.
Well, I only buy Teslas, so I just do it online. So it's like always been like 6 months, so it's pretty easy. But like, yes, I understand the hypotheticals of this. What about interest rates, like, and how much they impact your monthly costs? Like if $500,000 place, 3% beginning of the year, Today it's $500,000 and it's 7%. Your payments are what, doubling?
Yeah.
Okay.
Well, take a look at this buy down program. So as an example, you get a rate of, let's just call it 7% on a $400,000 loan. Okay. At the end of the day, that mortgage payment is $2,658.
Okay.
Okay. For 2 percentage points lower, that payment comes to $2,144. So it's
So it drops
$516 a month.
That's a big difference.
Yeah, huge.
You do a lot with $500 a month.
Yeah, that's $6,000 a year.
Yeah, that's a
You
big
know?
savings. So by doing these buy down programs, it's just another option for you to kind of wait for the mortgage rates to kind of correct themselves.
Yeah.
And kind of buy some time and how much does a refinance cost normally later on?
You're always going to you're always going to have an option where you can spend no money, or you're in Illinois. It's typically $2,700 to refinance a mortgage. So, at the end of the day, if you're at a 7% interest rate, and now I come back to you and say, okay, you can get 6% and you can spend $2,700, or you can get 6.25% and spend nothing. They give you that flexibility to do that.
How many people choose the free versus the 2,700?
9 out of 10 people.
Choose the free?
Yeah. Why wouldn't you? Your break even's day one. There's no investment up front. So you're not getting the lowest rate you can, but you're also saving money and not spending $1 to do that.
What's the savings in a 6.2 to 6% on average?
On a $400,000 loan, $50-$60 a month. So,
so like
why
3 to
again?
4 years.
It goes to the economics of the break
long are you
even.
gonna be there
Why,
for?
how long are you going to be there, and
Yep.
why spend it?
Yep. What about the best advice you could give to clients right now that are freaking out about rates?
At the end of the day, I think you can capitalize given the fact that home, I've got so many people who are like, I wish I
Right.
would have bought last year.
Right.
I wish I would have done this. It's like,
Yeah.
okay, what did I tell all the people that came in the market and were like, I don't want to get in this market. I'm not going to pay 20% more for the house.
Right.
I'm not bidding on anything. I said, look, here's what's going to happen. You're either going to overpay for your home and get a 3% mortgage rate,
Right.
or you're going to wait for home prices to come down and rates are going to be double.
Right.
That's exactly what happens.
100%.
So you're paying the same amount no matter which way you slice and dice it. It's just how you psychologically want to prepare yourself for what it means to you.
Well, you're either a buyer or not a buyer. And I hate to say it to
Right.
people, but that's what I say to people. And the reality is that like when we talk about these shoulda, woulda, coulda buyers, I deal with a lot of them in the fall. So if you're watching this and you're a fall buyer, this is what happens a lot. And it's the same type of people who always tell me, well, I wish I would have bought that stock at X price. Well, guess what, guys? Stocks are down right now. They're low, so buy the dip. Put all
Right.
your money in the stock market.
Right.
Because I'll tell you, 6 months from now, you're going to be like, man, did you see how low that was in October? But you
Yeah.
didn't have the kahunas to do it.
Yeah.
So the reality is like you can never really predict anything. You get in when you want to get in, and you could deal with the fallout later. So like you could get in the market now, get a buy down program, pay the rate it is today, and just refinance later on.
I
That's
tell everyone, you date your mortgage. You don't
Right.
marry it.
Right.
Okay. How many people keep a mortgage for 30 years?
I mean,
Slim
I don't
to
know
none.
that stat, but I could tell you
Okay?
like not many.
Slim to none.
Yeah.
That's what the stat is.
I've lived in my place for 2 years. I've refinanced twice.
Correct. So at the end of the day, now you're not going to do that because now we're not living in a pandemic where rates are artificially
No,
low,
I think
right?
I think I have a 2%
at
rate.
the end of the day, that's just what
Yeah.
happens.
Right.
So,
Right.
and this is where I tell everybody, look at the payment. Forget the rate, okay? You're not going to be happy seeing a 6.5%, 7.5% interest rate. You're just not.
Right.
But look at the affordability factor. Get comfortable with how much it's going to cost you, because when you buy your house and you close on your house, are you going to remember what your rate is every month, or are you going to remember what your payment is every month?
Right. I mean, and payment obviously has a lot to do with it. But do you think because of all this rates, do you think this is kind of like a signal for some turbulence ahead in the economy and the market, et cetera?
Yeah. I mean, I think everybody's afraid. I don't think rates are deterring people from buying home. I think the stock market continuing to go down.
Yep.
I think the Fed changing their tune on what they're going to do from one day to the next. It's almost like, listen, just get it over with. If you're
Yeah.
going to make rates 8%, make them 8% right
Yeah.
now. Let's not do this every 2 months and drag it on and drag it on
Yeah,
and drag
just rip
it
the
on.
Band-Aid off.
But, there's politics in the world, and,
Yeah.
at the end of the day, unemployment numbers were good last month. Is that really true? I mean, are that many people hiring people right now? You hear tech firms laying off 46% of their staffs. You've got
Yeah.
Amazon closing 30 distribution centers. I mean,
Right.
things aren't the greatest. So I think between the stock market, the state of the economy, just general politics and the discourse we have in this country and the divide we have,
Yeah.
it's giving people pause. I don't think rates are stopping people from, look, my phone still rings all day, every day with people wanting to buy homes. There
Right.
are buyers out there.
Yeah.
It's not like nobody's buying a home at the end of the day.
I say this every year, is that every fall, it's doom and gloom. Everybody's going to tell me the world's going to end.
Correct.
And then after January hits, it's new year, new me, and it's the greatest market of all time. It happens every single year.
I don't, do you think we had a spring market this year?
I think we're going to have a phenomenal spring market this year.
Right, but do you think we had a spring market this year?
I think we did, yeah.
Yeah, I don't feel like it was like the last couple years because there really was every market where there was no seasonal market. But I think you're going to see a really good spring market because at the end of the day, this is what the Fed is trying to do. They're trying to drive up the costs, right? And at the end of the day, they're driving up the cost to borrow money so they can bring supply back into control. There'll be a lot more inventory, I would assume. You probably know better than I, but I would assume there's going to be a lot of inventory on the market in the springtime.
Yeah, well, I mean, for the record, we had the greatest spring we've ever had in history, but that's a different story. But I will say is
You're
that
just better than everybody else.
I will say that what a big thing I'm seeing right now and a trend to watch for why I think we're going to have a phenomenal spring is that I would say more than half my buyers have gone on pause or decided to rent or find a short-term rental because they want to take advantage of the spring market. They think that the market's going to be even better for buyers. And I keep saying, like, there's no better time than now because here's the trend we're seeing is that inventory is rolling off in droves because in the markets we work, people aren't desperate, people aren't like hurting financially. So like, fuck it, I don't need to drop it 100,000. I'm just going to rent it because rents are an all-time high right now.
Nuts.
So sellers are renting, and that's taking inventory down. At the same time, demand's going down. Okay.
Correct.
After the first of the year, all this demand is going to go back up, and rates, in my opinion, I think are going to drop lower than where they are today. I don't think they're going to be at 3%.
No.
But what's going to happen, guys, is because people are doing year to 18-month long leases. Demand's going to or inventory is going to remain here. So we're going to see a very, very, very strong spring market. And every buyer then I know is going to tell me like, well, now the market's too hot. And I'm going to tell you, no, the market's not too hot. It's just back to where a normal market will go. Right now it's just a little fictitious. You have the perfect storm of not a lot of good quality inventory coming on because sellers are nervous to list in the current economic environment. You have a lot of buyers who are pausing on their searches. We're heading into holiday season. And after the first year, that's all going to flip. And we're going to see, in my opinion, an insane spring market for the markets we work. I think suburbs and stuff like that are going to be a little bit different. But for the markets we work, I think they're going to get pretty crazy. And a huge trend to watch, remember I said this, I want to play this clip back when it happens, is the downtown market, the high-rise market. As this recession gets worse, more and more companies are going to call their people back to the office.
Yeah.
And with inventory in the Loop and in the near north side is at the lowest point it's been in right now since pre-pandemic. We're at 5.5 months right now. We got to 24 months in the spring of 2020. We're going to be down probably to 4 months, which is a balanced market for the first time in 3 years. It'll be interesting to see what happens in the spring market.
Yeah.
But I have a knack for understanding where the things go. We can watch our other podcasts where we talk about these type of trends. But we do have our finger on the pulse. So it'll be interesting to see what happens with the markets. The last thing let's talk about, what's the last piece of advice that you're advising your clients to do to work through these unsustainable high rates?
I tell everyone, buckle their seatbelts at the end of the day. You can't get pre-approved too early. You've got to figure out what you can afford. Mm-hmm. If you're calling me and you're buying in the springtime and we're talking now and rates are 6.5% or 7% today, well, use 7.5% today.
Right.
So you're mentally and psychologically prepared for that swing in payment. It's just like my buyers who, because I lend in every city and state in the union, and you've got people buying in Florida and you've got people buying in California, right? So if I've got a buyer calling me in California and they're buying a $3.5 million home, right? At the end of the day, it's like there's insurance problems going on in the state of California right now. So, hey, listen, I know you're worried about your interest rate right now, but are you worried about your insurance premium that would normally be $5,000 a year and is now $25,000 a year?
Yeah.
Right. So maybe you should call your insurance broker before you actually buy the house so you don't get sticker shock. So, at the end of the day, it's more just I always revert back to, and I've been this way from the day I got into the business. I just sell payment.
Right.
Because that's what you remember at the end of the day. That's what comes out of your bank account at the end of the day. You date your mortgage, you don't marry it. And at the end of the day, there will be an opportunity to refinance. Right. It's just a matter of, is that 6 months, 12 months, 2 years away? Nobody knows. Like I think you said, we're never going to see rates probably in the 3% range again.
It's never
unless we have a
history.
Catastrophic event. And I don't know about you, but like, I don't want to be locked in my house again.
Right.
I don't want to not be able to go outside and eat dinner or do whatever I want to do. So,
right.
people need need to put things into perspective. The average interest rate over the last 25 years on a 30-year mortgage is, I think, 7.5%.
Yep.
And we're almost there again.
Right.
It's not bad.
Right.
You
Could
know?
be worse.
So
Could be-
at the end
could
of the
be
day,
18%.
the sky isn't falling. You know,
Right.
I'm sure you deal with this just like I do. You can't time the purchase of a home
Right.
around what you think the value of the home is going to be or what you think the interest rate is going to be. I mean, take a look at real estate since the pandemic hit. What was the value of a home before the pandemic hit? What was the value of a home when the pandemic hit? What
Right.
was it during the pandemic? And what is it now?
Right.
You're going to see this.
Right.
Just like you always do. Now, in this market here in Chicago, you don't see the big shifts and the swings like we see on the East Coast and the left coast and Texas.
Correct.
But,
Right.
you know, I've got to remind people, well, prices are coming down. Yeah, but prices are so inflated to begin with right now.
Right.
So, yeah, prices might come down 10%, but they're still up 30% from where they were.
Right. And that's a big thing, too, is because it lends across the country. Is like in Chicago, when people tell me the prices are up, I'm like, okay, well, let's look at Lincoln Park, which performed one of the hottest, and it's up on average like 10 to 12% for properties under $1 million in the last 3 years, which is about 3 to 4% appreciation a year, which is actually on average for what we normally appreciate.
Yeah.
And if you look at the north side, we're down 20% in some buildings.
Yeah.
So like, how can we cool off if we never get hot? If we're down 20%, I think we went through a crash.
Yeah.
You know, so like all of it's in perspective. The main thing to do is understand what your options are. Think of things like, you know, buyback programs or buy down
yeah.
programs.
Yeah.
Keep your options open and don't worry about a rate. Worry about a payment.
Yeah.
All right, guys. Thanks for listening to Laricy Live.
Thank you. Good stuff.